And that model's been deadly accurate on the value of the model, because any network can be determined, the value of it, based on this Metcalfe's law and the number of participants in the network. Make a long story short, if the price at 29 is lower than 55, then as an investor, I should want to accumulate. I should want to buy, right? Well, then what happens is, as we get toward the halving, that'll happen next, April, and next June we'll shift into crypto fall.
Hey guys, welcome back to Everyday Finance. In this video, Mark Yusko discuss about crypto summer and Bitcoin. Mark Yusko says, the crypto summer is a period of time when the market tends to move upward generally. It's not a sharp rise, but rather a gradual one with greater highs and lower lows that resemble a roller coaster riding up a track. Why is it, and what causes it? Investors, including me, I consider myself an investor, have done the legwork. We have examined the value models for hours upon hours, and we have determined that, using Bitcoin as an example, the Metcalfe law model is 55K. As an investor, if the price at 29 is less than 55, I should want to accumulate and buy right away, however. As we get closer to that happening, in April and June of next year, there will be a shift into the cryptocurrency fall. After that transition, traders start to enter the market because we'll be getting closer to that fair value, and traders simply see movement. Again, this is not a politically correct topic to discuss, but men and women actually turn out to be different, and lots of things Mark Yusko discuss. And don't miss best advice from Mark Yusko to investors. So please watch the video to end, and like, share, subscribe our channel Everyday Finance. Thanks.
I think it's an interesting dynamic when you think about crypto and why we have this 4-year cycle. And we're in what I refer to as crypto summer right now. Well, what is crypto summer? Crypto summer is that time where the market has a generally upward drift. It's not dramatic, but slowly upward, higher highs, higher lows, just kind of, like a roller coaster, kind of moving its way up the track. And what causes that? Well, what causes that is investors, like myself, I consider myself an investor, have done the work, right? We spend hours and hours and hours looking at the value models and said, okay, the Metcalfe's law model of Bitcoin, which use Bitcoin as an example, is 55K. Now you can say, well, that number's silly. No, Tim Peterson, my buddy, has this great model. You should have him on the show sometime. He's amazing. And that model's been deadly accurate on the value of the model, because any network can be determined, the value of it, based on this Metcalfe's law and the number of participants in the network. Make a long story short, if the price at 29 is lower than 55, then as an investor, I should want to accumulate. I should want to buy, right? Well, then what happens is, as we get toward the halving, that'll happen next, April, and next June we'll shift into crypto fall. In that transition post-halving, crypto fall is where the traders start to come in, because we'll start to approach that fair value, and the traders just see movement. And again, it's not politically correct to talk about, but men and women, turns out, are different. I know everybody doesn't want to talk about that, but they are. And one fundamental difference is not having babies or not, but one fundamental difference is hunters and gatherers, right? From prehistoric times, there were hunters. And it doesn't mean they were all men, predominantly men. I guess there could have been some women hunters, but anyway. And then there are gatherers, the nurturers. Well, what's a skill you need as a hunter? You need head on a swivel, right? Because it's got all these things trying to kill you, and you're out trying to kill something.
Being aware of anything that's moving will always take precedent.
Anything that's moving. Like if somebody walks across my outside hallway there, I will look at them.
Yeah.
If it ain't moving, I can't see it. And I have proof. And I know people say, I'm tired of this story. Well, it's true. My wife says, get the ketchup. I open the fridge. Honey, there's no ketchup. She walks up, grabs ketchup bottle. If it ain't moving, I can't see it. So it is truly dazzling. And so and this is true the vast majority of people trading happen to be men. It shouldn't be that way, but it is. And therefore, there's an exacerbation of this. And there's actually a lot of good literature on this. The difference between males and females in trading and investing. And it turns out women tend to be better investors because they're not as overconfident. They don't overtrade. They don't trade things they don't understand. Guys are like, oh, I know how to do that. But
we take the loss, then we read the manual.
Yeah,
and we only read half the manual.
Exactly. Yeah. Exactly. We read the manual eventually, after we crash. But the part is that trading is fine. And the good traders come in and they'll actually push the price a little bit.
And I ask this question to Mark about ETF. Mark, how you see things from a certain angle. That being said, I should say that the clear best news in Bitcoin history is what some people think about these spot ETFs coming in, especially everyone talking about BlackRock. Do you think you talked about this? I won't even call it immaturity. I'll just call it the immaturity of the Bitcoin owners. What do you think about the crypto space now that the stamp of approval has come? Traders with real jobs, companies, smart money, and Larry Fink and BlackRock are all coming in. What do you think? Will that change the way the price movement works? Changes because there will be more grown-ups in the space. Or do you think it will stay the same? As a joke, as these new people join, so will the number of people who know about Bitcoin and other cryptocurrencies. We'll still bring in a lot of people who have no idea what's going on. For example, how do you deal with the when institutions are involved?
Look, it's a fantastic question. And it kind of goes to the heart of where we are in this evolution of the cycle and of the technology. So if you think about how every technology comes into being, they all follow an S curve, right? So it looks like a big letter S, and the first 10% come in over the first decade. Then the next 80% come in over the next decade, and then it matures over the last decade. And you go from the originators to the early adopters to the early majority, and then you have this inflection point. And I think we're about at that inflection point, because the first 4 years, I don't really count them because it was kind of a science experiment and there was like 7 people involved, and last 10 years it's real. And
right.
So
especially this whole last cycle too. Yeah. Yeah. And so we're at that inflection point, and yes, institutions theoretically are better decision makers than retail individuals. The problem is a lot of institutions suffer the same problem because they're run by small groups of humans. Yeah. And those groups tend to make equally bad decisions. The pension funds in particular have a long history of being just as bad as individual investors. So I don't know that the institutional money coming in is going to be quite the panacea that everybody thinks.
Good advice from Mark Yusko. Paul's a trader, not an investor. There is a big difference between the two, and neither is good nor bad, just different investors. Those who put in the work to understand an asset's value in relation to its price understand that when the price is below the value, they must buy. And if the price moves away from fair value, they must buy more. When the price is above fair value, they must sell. And when the price is much above fair value, they must sell a lot. An investor, on the other hand, is very different from a trader. Traders don't care about fair value, they just want movement, and they want to scalp. Both trading is extremely difficult, and most people are not very good at it. This is because it can be difficult to ignore the noise about value and what the business does. They don't really care if the price is rising or falling. They are buying and selling. The real issue arises later in cycles, as we have all seen, when trading is combined with leverage.
And so basically what he's saying is only a loser buys more of something when it goes down, right? Okay, but wait, that's the opposite of what you just said, Mark. You're supposed to buy things when they go on sale. Difference. Paul's a trader, not an investor. It's a very big difference. And not good or bad, just different. investors, right? People who do the work, right? Do the work to understand the value of an asset relative to its price. When the price is below the value, they must buy. And if the price moves away from fair value, you must buy more. When the price is above fair value, you have to sell. When the price is way above fair value, you have to sell a lot. Now, an investor is very different than a trader. A trader doesn't care about fair value. They just want movement. They want to scalp on the way up and they want to scalp on the way down. They're agnostic as to the direction of the market. And both are perfectly acceptable. Trading is really hard. The average person is not very good at it. It's because it's really hard to block out all the noise about value and what does the business do. They don't really care. If the price is moving, they're buying it. If the price is going down, they're selling it. The real problem comes in late in the cycles, and we've all seen it, when you combine trading with leverage. Right? Here's the killer cocktail. Leverage can never make a bad investment good. It can, and often does, make a good investment bad. Why? Because you're forced to sell at the wrong time. So if you get a margin call and your assets fall in 50%, you don't get to sell that asset and pay back the margin. You have to sell some other asset that hasn't gone down. Well, that's the antithesis of what you should be doing, right? If you've done your homework and this is a good asset, you would actually want to be buying more. But here's the problem. You said it. The average person doesn't do their homework. They heard somebody mention something. They don't think about, was that person being paid to mention that? Does that person have a meaningful percentage of their net worth in it? Or is it one of 100 different positions? And, now we have the internet media. It's worse because now people do get compensated for talking about things on air. I mean, I never do, but that's just, my choice. I don't want to be compensated.